Well, good morning and welcome. My name is Teresa Campbell, and you have joined the PIM, Printing Industry Midwest, and PIA Mid-America Financial Executives Council program. Today's topic is Economic Outlook from the Federal Reserve. Note that all attendees are placed in mute mode to ensure a quality recording. However, we really encourage comments and questions during the program. We prefer that you type them into the Q&A field at the bottom of your screen to be asked at the appropriate time, and I'll help moderate those for our presenter. If you have technical difficulties, we ask you to put that in the chat field. The Financial Executives Council is coordinated by leaders in both the North Central and South Central regions of the United States. They guide the programs and content that are offered every other month, 6 times a year. The focus is around financial reporting and compliance, data management and security, and financial policies and planning. Our council co-chairs are Matt Wills with LB Carlson, Carl Nathy with Myers Printing, Ken Rain with Daily Printing, and Ryan Wagner with Action Mailing and Printing. Let's get started. Ryan, do you want to introduce our speaker?
Yeah, I want to thank everybody for being here today and thank Alison for her time. Alison Felix is Senior Policy Advisor at the Federal Reserve Bank of Kansas City. In this role, she is responsible for briefing the Kansas City Fed's president, a member of the Federal Open Market Committee on Economic and Business Activity in the 10th District. In addition, Felix conducts research on issues related to public finance, labor dynamics, and regional growth trends. Felix recently served as Vice President and Denver Branch Executive, where she conducted research and outreach related to economies of Colorado, Wyoming, and northern New Mexico. Alison used her time in this position to broaden her understanding of the 10th District regional economies, as well as recruiting and working closely with the branch's board of directors. Felix joined the Federal Reserve in 2007 as an economist in the Regional Affairs Department in Kansas City and was promoted to the Denver Branch Executive in 2012. She holds a PhD and MA in Economics from the University of Michigan and a Bachelor of Arts in Mathematics and Economics from Kansas State University. Felix currently serves on the Advisory Council for Kansas State University Department of Economics and on the Colorado Governor's Revenue Estimating Advisory Committee. She also participates on the Metropolitan State University Community Cabinet, Mile High United Way's Community Impact Committee, and is a member of the Denver Association of Business Economists. Welcome, Alison, and we look forward to speaking with you.
Great, thanks so much for that introduction. Good morning, and thank you for the invitation to join you today to talk about the outlook for the U.S. economy. As Ryan mentioned, I'm Alison Felix, and I'm a Senior Policy Advisor for the Federal Reserve Bank of Kansas City. I'm actually sitting in our Denver branch today, but the Federal Reserve Bank of Kansas City covers a much broader region, a 7-state region. So we include Wyoming, Colorado, New Mexico, Nebraska, Kansas, Oklahoma, and Western Missouri. Throughout my 17 years at the Federal Reserve, I've been both on the regional economic side and also on the national economic side. So I help to brief our president on kind of what's happening in the regional economy, but also what's happening on the national economy. I'm going to concentrate my comments today on really the national side of things. But I really look forward to hearing from you. So make sure to put questions or just comments in the Q&A field. I'd love to hear how business conditions are going in your areas of the country and in your specific business. We really take a lot of those comments and try to feed that into our reports to our president. So before I begin today, you probably noticed the disclaimer on the front slide here. Just please note that all of the views that I present today are entirely my own and do not necessarily reflect the views of the Federal Reserve Bank of Kansas City or the Federal Reserve System. And the slide isn't advancing. There we go. Okay, so I wanted to start the presentation this morning by just kind of giving an overview of what I see as the overall themes in the U.S. economy. The first bullet there, you can see the U.S. economy has really been fairly resilient, and in particular, more resilient than most economists expected, despite tighter monetary policy and high inflation. So really, those GDP numbers have kept coming in higher than anticipated. The economy is in fairly good shape. So I'll talk quite a bit about that today. In addition, as supply constraints eased and interest rates rose, inflation has moderated substantially over the past couple of years, but recent data provide additional evidence that inflation still remains too high. So at the Federal Reserve, we've set a target inflation rate of 2%, and we still see inflation that's coming in on a year-over-year level quite a bit higher than that. Increases in labor supply have helped to ease labor constraints and have supported solid employment gains, but further easing in the labor market will likely require declines in labor demand. Thus far, however, consumer spending and new orders at manufacturing and services firms have been fairly resilient, keeping labor demand elevated. So this overall resiliency in the US economy has led market participants to start to pull back on their expectations for the Federal Reserve to make rate cuts, resulting in market expectations that are now fairly aligned with FOMC median projections for the federal funds rate. So I'll kind of end talking about monetary policy today. So first, here you can see on this first chart, this starts by really kicking off showing the overall resiliency of the US economy. And really, this has been in the face of pretty tight monetary policy and also fairly high inflation. So you can see, as everybody here knows, we saw a very sharp decline in economic activity with the onset of the pandemic in early 2020. That actually very quickly reversed in late 2020 and early 2021. And then we started to see the economy slow a bit. So inflation was quite high. The economy started to slow, but you can see that it bounced back. And 2023 was really a remarkable year, very strong GDP growth. Q4 over Q4, we saw GDP grow 3.1%. That's quite a bit above what we would expect for kind of a trend rate of growth in the US economy. So very healthy conditions. And we saw that even as inflation was coming down pretty substantially and unemployment rates were remaining quite low. So it was really quite a good outcome for the US economy and for the Federal Reserve as it looks at its dual mandate. And you can see in the last three bars there, kind of the burgundy and the yellow shaded portion, those are the range of forecasts coming from the Federal Open Market Committee. And you can see that in 2024, we're expecting growth somewhere between 2 and 2.4%. And remaining kind of above trend for this 3-year forecast horizon. So this would continue to look like a fairly healthy US economy, a little bit above what we would expect over the longer term. And so I'm going to look at some of the reasons for those expectations on the next few slides. So first, I think really the key thing that the Federal Reserve has been watching over the last few years has been the inflation number. So at the Federal Reserve, we have a dual mandate, both to promote maximum employment, but also to promote price stability. And so the employment front, the labor market has looked quite healthy really over the last several years. It's the inflation side where we've seen inflation numbers come in quite a bit higher than we would like to see. So if you look first at the chart on the left, you can see that overall inflation has come down pretty significantly over the last couple of years from its peak levels. So at peak, we saw inflation rates as measured by kind of headline PCE inflation a little bit over 7%. If you look at the latest year-over-year numbers, inflation is measuring about 2.4%. So considerable progress, certainly, but still remaining above that 2% inflation target that the Federal Reserve has set. Now, what I've shown on the left-hand chart actually shows the 3-month percent change at an annualized rate. So you can see that we've made a little bit more progress when you look at that 3-month percent change, so not the 12-month percent change. And in fact, in December, this was looking very good. It looked like really we were moving close to that 2% target. But the January and February numbers really gave us a little bit of pause. Those inflation numbers came in a little bit stronger. This chart here only reflects January. So far, we only have the February number for the CPI, a different measure of inflation, but both of those measures have come in a little bit stronger in January and February. Certainly nothing alarming, but enough to say, really, have we done enough to get sustainably back to that 2% target? And so right now, when you look at the Federal Open Market Committee, the committee that sets monetary policy, really there hasn't been enough evidence to show that we're sustainably on a path to maintain that 2% inflation rate. And if you look at the right-hand chart, I think this really tells the story that's underlying those key components of inflation. So this breaks down core inflation into 3 different components. So first, I should mention that core inflation subtracts out the food and energy costs from headline inflation. So on the left-hand side, you can see headline, which includes everything. On the blue line, the green line shows core, so subtracting out those food and energy costs, so just slightly less volatile than the headline inflation, which is really the reason that we're looking at it. And then looking at the right-hand side, broken down this core component into core goods in the blue line, core services, subtracting out housing costs in that green line, and then housing costs. And so you can see that core goods has really shown kind of the most volatility kind of during this pandemic era. As supply chains really faltered and as demand for a lot of goods, as people were stuck at home, soared in 2021, you can see that prices really shot up for core goods. But since then, they've really made remarkable progress. They've come back down to about where they would normally sit kind of at a pre-pandemic inflation rate. It's the other 2 components here that really we'd like to see a little bit more progress. In particular, if you look at that core services X housing, so think of all of the services that individuals purchase, you can see that that rate of inflation has remained stubbornly high. And so that's one of the pieces that we're watching carefully. You'll often hear that referred to lately as supercore inflation. And so that's the piece that a lot of attention is being devoted to trying to determine when that piece will start to come down. One thing keeping that supercore inflation relatively high is wage growth. So we know on the services side of the economy, a lot of the costs that firms face are related to labor. So here you can see supercore inflation plotted right next to wage inflation, and you can see that they tend to follow each other fairly carefully. So as wage inflation starts to come down, we would expect that supercore inflation to kind of follow that trend over the long run. But we really still have quite a ways to go to kind of get back to a level of wage inflation that we were seeing prior to the pandemic. And also right now, I'd personally really look at inflation and see probably more upside risks than downside risks to how inflation is going to come in. And I've shown just 2 upside risks here on this slide. So on the left-hand side, you can see 2 different measures of supply chain pressure. So you're both looking in the blue line at freight rates for shipping, and then also an indicator of how much pressure is in the supply chain. And you can see that both are substantially lower than what we saw early on during the pandemic era, but they have been moving up pretty significantly throughout the second half of 2023. And really that's due to disruptions at 2 critical shipping routes that are really creating these upside risks to inflation. So probably the one that you hear about the most is the attacks on vessels in the Red Sea area, so the Suez Canal. That's creating some disruptions to shipping, and in particular, a lot of shipping is now taking a different route that takes a longer amount of time. So it's kind of it's increasing delivery times, but it's also increasing the cost of those deliveries. The other route that's being disrupted somewhat is severe drought conditions at the Panama Canal. So that's slowing, it's reducing the amount of volume that can go through the Panama Canal, and again, increasing delivery times and costs. So that's something that we're watching carefully. I think right now it's not having a huge impact on inflation in the US economy, but it's something that we're watching to see if it does start to trickle into prices in the US. On the right-hand side, completely different upside risk, but you can see that based on financial markets, that inflation expectations have started to move up when you look at the 1-year and 2-year break-even inflation rates. So they had been sitting kind of nicely near that 2% target that the Federal Reserve has set, but just over the last few months, those break-even inflation rates have started to creep up So that's, again, another indicator that we're watching to see if that bleeds through into overall inflation rates. So on the inflation side of things, we have seen considerable progress. So we've moved from an inflation rate that was over 7%. We've moved down really fairly close to 2%, but we're hovering around that 2.5% inflation rate. But there's some upside risks, I think, to overall inflation, and we just haven't seen quite enough good data to really be convinced that we're going to get immediately back down to that 2% target. So
Alison,
yes, go ahead.
There's a question about that slide. Do you see transportation supply chain continuing to stabilize, or are these disruptions going to have an impact going forward? What are your thoughts?
Yeah, I mean, I think that's a good question. I mean, I think that's one of the reasons that we're watching this so carefully. I mean, I think on the plus side, you can see that we're really nowhere near where we were in 2021. So, this isn't nearly as disruptive to the US economy as what we saw just a few years ago. So I think that's one of the positive indicators. Another positive indicator is that really the disruptions in the Red Sea area have a much larger impact on Europe than they would have on the US economy. So I think right now, the effect of this on the US economy is likely fairly minimal. But we do think that delivery times are likely to stay a little bit higher than they had been. We already saw a lot of manufacturers looking for kind of alternative suppliers during that 2021 period. And I think that kind of diversifying the supply chain will continue to happen. But at this stage, not seeing this have like really a huge impact on overall inflation or the US economy, probably likely to have a little bit more of an impact on the European economy.
Is employment keeping up in the transportation industry?
Employment has been fairly strong across most sectors, including the transportation industry. This really highlights here, this is specific to shipping. And so I haven't looked specifically at the shipping side of things, but a lot of transportation in the US is also occurring by truck. Trucking's been, very strong over the last few years. We've seen a lot of increase in kind of warehouse space, a lot of online orders, a lot of trucking activity, delivery type things. And so it's been fairly strong, probably slowed a little bit here in recent months, but I would say still remains elevated compared to pre-pandemic.
Can you address supply chain impact of the Baltimore tragedy?
Yeah, I mean, certainly a huge tragedy, and I'm certainly not an expert. From what I've seen so far, it will likely take them quite some time to get that port up and fully at capacity again. I think that I saw that that's the 15th largest port in the US economy. So I don't think it's anticipated to have a huge impact on the entire US economy or on inflation or our ability to bring in trade, but certainly it'll have a big impact on that region of the country. But again, because it's the 15th largest, not anticipated to have a huge overall impact on the US economy.
And then there's another question. Does this inflation appear to be trickling down to the trucking industry and other transportation rates?
Ooh, that's a good question. I'm going to be honest. I don't think we've seen a huge, well, it does look like a pretty big increase here, but again, much lower than it had been in 2021. I think other rates are also elevated compared to pre-pandemic, but not, again, they've come down from where they were when markets were really tight in 2021. I would expect there to be some overlap or some correlation between the different shipping rates, but it's not something I've looked at recently, so I can't say for sure. Any other questions?
I think that's it for now.
Okay, so that was great timing. So kind of wrapped up there, at least temporarily, on the inflation side of things. And now I want to turn to the labor market side of things. So I mentioned that the Federal Reserve has a dual mandate, both to promote maximum employment and also to promote price stability. So this is kind of looking at that maximum employment side of things. So you can see here that labor markets remain tight with an unemployment rate under 4% and payroll gains exceeding 250,000 on average in 2024. So looking first at the left-hand side, this is just average monthly payroll growth. So these are annual averages in the blue bars. Those green bars are monthly numbers that we've seen come in so far in January and February. I think both of the measures that have come in so far this year have surprised to the upside. Those are pretty strong numbers. You can see, so what we saw there is in 2020, we saw that very sharp decline in employment with a pretty fast rebound in 2021. So these are huge monthly payroll gains compared to what we would see on average. And those have gradually slowed as we expected, as we kind of regained those jobs lost during the pandemic. But now, even with a very tight labor market, so an unemployment rate that's currently sitting at 3.9%, we're continuing to see employment gains on a monthly basis that are above their pre-pandemic average. So these are very strong gains. In fact, we think that we need closer to about 110,000 jobs added per month to keep pace with new entrants into the labor force. So if our goal was to keep that unemployment rate steady, we would only need about 110,000 jobs on average per month. And so we're more than doubling that right now. So this is a very healthy looking labor market, very tight labor market conditions. And this is one of the things that I think that points to the narrative kind of in the media where people are asking, are we going to be able to achieve kind of this soft landing, right? So what do we kind of mean by a soft landing? Can we bring inflation down to that 2% target without significantly increasing unemployment rates? And I think the really encouraging thing that we've seen over the past year is that so far we've really been able to make a lot of progress bringing down inflation, even as when you look at this right-hand chart, unemployment rates have really just barely ticked up, right? We're still seeing a 3.9% unemployment rate, which is really a really healthy level of unemployment rate in the US economy. And one of the things that's really helped us to do that so far is that we've seen significant improvements in the labor supply, and that's really helped to ease some of the pressure on labor markets. So if you look at the left-hand side, this shows the labor force participation rate. So if you look at the blue line in particular to start with, that's the overall labor force participation rate, and that would include anyone over 16 years of age. So you can see that if you just look at that number, you would look at it and say, well, the current labor force participation rate is quite a bit below where it was when we headed into the pandemic, right? So we still have kind of a lower level of participation. But then you look at the green line, and that's an age-adjusted labor force participation rate. And it's kind of back to what we would have expected pre-pandemic. And so what we've done there is we've just accounted for the shifting demographics in the US economy. So we have been expecting for quite some time that as the baby boom generation retires, that's going to put some downward pressure on labor force participation rates. So naturally, we would expect as people kind of reach an older age, we're going to see more and more retirements. That generation was so large that as that happens, it's putting some downward pressure overall on labor force participation rates. When we adjust for that, we can see that labor force participation rates have kind of jumped back up over the last year to, either at or a little bit above their pre-pandemic levels. So we've seen a pretty nice surge in participation rates over the last couple of years, and that's really helped us to have these really strong employment gains that we've seen. On the right-hand side is another big factor that we've really seen over the last year that's helped. So if you look at the blue line, you can see this is just population of ages 16 plus. Population growth has been pretty sluggish in the US. So you can see that we're still below trend. Birth rates have been lower than they were in previous generations. And so our population is growing fairly slowly in the US at a slower rate than we were seeing in the years leading up to the pandemic. But what has happened over the last year is that foreign-born, so immigration, has really picked up over the past year. And again, that's helped us to fill a lot of job openings in the US economy. So you can see that immigration really fell during that pandemic period. But over the last year or two, it's really moved back up. And now it's back to where we would have expected it to be, kind of back to trend in the US economy. So those two things have really helped to fill a lot of job openings in the economy and really helped to ease some of those labor market pressures.
Do you think that the state or municipal mandated minimum wage increases will affect full employment, or will it decrease jobs?
Oh, so there's a lot of, I mean, it's a good question. There's a lot of research, economic research out there on the effects of minimum wages. And I think from my reading, there are varying views on the effects of the minimum wage. I think most economic research looks at the effects of kind of small minimal increases in the minimum wage on overall employment. And they either find that there's not a lot of impact. So there's either kind of zero impact on employment or maybe a small negative impact on employment. So I think in most places, an increase in the minimum wage, especially if you're talking, say you're talking an increase in the national minimum wage, which I know was not the question, but there the minimum wage is quite low. There's not a lot of people earning that hourly wage. So if you were to increase that, say by $1 or $2, you probably wouldn't see a big impact just because it's not affecting a lot of workers, right? There's not a lot of workers making $7.50 an hour. On the other side, I think the question is more at the state level or some city levels, you've seen much larger increases in the minimum wage. And there, I think the evidence is a little bit more scarce. We don't have as much economic research that's looking at that type of impact where you're increasing the minimum wage and it's now affecting a much larger share of the workforce. I think in that case, this is just my own view, that as you see those minimum wages move up to higher rates, and it's impacting a pretty large share, at least within certain industries, that you're likely to see a little bit bigger impact on employment. So you're likely to see some negative impact on employment. In terms of overall, total wages or total income, you might still see a positive impact there, total income to go up, but still you could see a slight negative impact on employment. Okay, so moving on then to the next slide. So this shows the improvements in labor supply. But given that we're back to kind of pre-pandemic trends here in terms of participation, really we're not expecting additional increases in supply to help us out more, to help ease these labor constraints. So what we would really need at this point to kind of bring down wage pressures is to have some easing in demand. So we need labor demand to start to ease. And we've seen just a little bit of that. So I want to start looking here at both the blue line and kind of this pink line. So the blue line shows the quits rate in the US economy. And what we tend to see is that employees are less likely to quit as jobs become harder to find. And so you can see that we've had this very slow, gradual decline in the quits rate over the last year or two. Still a little bit above what we were seeing pre-pandemic, but overall, this line is starting to kind of trend down. We're seeing a little bit of the same thing in that pink line. This is showing the number of job openings per the number of people that are unemployed. So that peaked at a little bit over 2, meaning that there were 2 jobs available for every unemployed worker. So that was historically a very high level of job openings. We've seen that gradually come down. It's closer to 1.5 at this point. So 1.5 jobs per number of people that are unemployed. So we've seen both of these measures of kind of labor demand start to ease a little bit over the past year. So still elevated. You can see that pink line in particular, the number of job openings is still very high, but it has eased. And then we've plotted against that an employment cost index. So this is just trying to look at all of the costs employers would face to employ someone. And you can see that that green line tracks pretty closely with those other 2 lines, but with a lag. So this is slightly mislabeled here. The employment cost index is actually lagged by 8 months. So you can see that with an 8-month lag, wages start to follow as demand starts to ease. So we could see wage pressures ease further in the coming months, just to kind of catch up with some of this easing that we've seen overall in the labor market. And in general, we would be looking in the next few months to see labor demand come down a little bit further to kind of help bring down some of those wage pressures. I think one of the really interesting things during this recovery period that we haven't always seen in previous recovery periods is that we've been able to make a lot of progress in bringing inflation down without increasing the unemployment rate. And a lot of that has been because just there's just fewer job openings. So we haven't actually had to lay off workers in order to make progress, but the level of job openings was so elevated this kind of initial easing in the labor market is really just coming not from laying off workers, but instead from just reducing the number of new job openings available, and that's helping to ease some of these labor constraints. So we're kind of looking for labor demand to ease somewhat, but overall demand has still remained fairly strong. So this shows the consumer spending side of things. Again, two sides here, but consumer spending still remains fairly elevated, and that's really been supported by strong household net worth. So starting on the left-hand side here, again, those straight lines are showing kind of this pre-pandemic trend where we would expect spending to have moved if not for kind of the pandemic. So you see in the blue line, that's spending on goods. So I talked a little bit about this earlier, but you saw this surge in spending on goods as soon as kind of that pandemic hit. So there was about a month where you couldn't get anything, and then people were kind of stuck at home and they started buying a lot more goods than they would normally buy. And you can see that even now, the amount that is being spent on goods remains much higher than we would have anticipated pre-pandemic. So over time, we'd probably expect that spending line to kind of move a little bit closer to that pre-pandemic trend. The green line shows spending on services. That was a little bit slower to recover. So if you think back to all of your experiences during the pandemic and the years that followed, it took some time, right, for restaurants to reopen, for concerts to come back online, for people to want to get back on an airplane and to go travel. So you can see that it took quite a bit of time for us to get back to that trend line. But over the last year or two, spending on services has been quite strong. We've seen a lot of growth in services spending, and I think that's really been the story over the last year. You hear a lot of people talk now about the kind of, this kind of normalizing a little bit. So people are starting to spend a little bit less on goods, and they're really increasing their spending on experiences. So whether that's travel or concerts, those have been big spending areas over the last year or two. And really, a lot of this spending has been supported by really strong household balance sheets. So you can see that there was a surge in net worth in 2021. So there were a lot of stimulus dollars that came out, a lot of support that came out in 2021 that really helped to boost overall net worth. And then since then, I mean, there have been very strong wage gains, strong income gains that have helped. Certainly over the past year, the stock market has done quite well. Housing prices have continued to go up if you own your home. So there are a lot of factors that are showing up in this overall net worth number. But in general, overall in the US economy, household net worth remains fairly elevated. So far, not seeing a lot of slowdown in consumer spending. Usually that would kind of trigger eventually a slowdown in demand, but we haven't really seen that. I will say that the retail sales data that came out in January and February of this year was a little bit weaker than expected. That January number in particular was quite weak. A lot of thought that some of that could be due to really severe weather in parts of the country. So people just weren't out and about doing things and spending money. We saw some rebound in February. February's number was positive, but it wasn't as strong as expected. And so we're kind of watching that data to see if that persists, right? 2 months probably isn't enough for us to really say that we see overall spending coming down, but there's some indication perhaps that we might see some slowdown in consumer spending in 2024. Potentially another reason for that is if we move to this next slide. So I mentioned that overall household balance sheets look quite strong. Even if you look at debt levels for US households, if you put debt to income, looks on average to be in a fairly good position. But this shows delinquencies for autos, mortgages, and credit cards. And you can see that in particular for credit cards, delinquencies have started to move up somewhat, really just over the last 6 months or so. So we know that some households are starting to feel some stress as they're facing, I think in particular, higher prices for kind of everyday purchases. So there is some stress building, I think, in the economy. And so we could see a little bit of pullback from some consumers. But overall, again, the picture looks pretty healthy. So that's one side of demand, would be consumer demand. So what are consumers spending? Is consumer spending still strong? Are we expecting it to slow? And I would say probably would expect it to moderate over the next year or two. But overall, the consumer looks fairly healthy. I think this is a similar story when you look at surveys coming from manufacturing firms and services firms. So the blue line shows manufacturing new orders, and the green shows services new orders. And this is measured to where 50 would indicate neutral. Anything above 50 indicates that new orders are expanding. Anything below 50 indicates that new orders are contracting. And so you can see on the services side, it's come down a little bit, but still well above that 50 mark, indicating that new orders are continuing to rise on the service side of the economy. So not really much stress there. So services new orders continuing to increase, which likely means that demand for labor is going to continue to increase on that services side of the economy. On the manufacturing side of things, you can see that there was a little bit of a slowdown last year in terms of manufacturing new orders, but that's actually picked up recently. So now it's sitting at about 50, indicating that new orders are roughly flat. So not really increasing much, but not really declining. So still indicating that demand for labor should remain fairly resilient on the manufacturing side as well. One thing I wanted to mention on the kind of slowdown in new orders last year, you might have expected that that would have really slowed down the overall economy. But one thing that we really saw is that a lot of manufacturers had a backlog of orders. So even as their new orders were slowing, they had pretty substantial, in many cases, backlogs of orders that were kind of allowed them to kind of fill that time period where new orders were a little bit more sluggish. And now new orders are bouncing back up again. So I think on both the manufacturing front and on the services front, you see fairly healthy new orders, indicating really not seeing a significant slowdown in the U.S. economy.
Alison, what is the outlook for interest rates, especially in the commercial loans industry?
Sure. Well, let me actually go to the next slide here, and I think that's going to talk a little bit about it. So, and then I can come back to the commercial sector specifically, because this is kind of this is the last slide that I have here. So this kind of brings together kind of the full picture. So we've seen an overall fairly resilient economy. We've seen a labor market that remains fairly tight. Unemployment rates still below 4%. And we've seen inflation make considerable progress. So it's come down from over 7% to just above 2%. So it remains above our target inflation rate of 2%, but has made considerable progress. And so as that data continues to point to a resilient economy with above target inflation, market participants have really pulled back their expectation for rate cuts. So here what you're seeing is the blue line is showing the federal funds rate. So this is the rate that the Federal Reserve controls. And you can see that we have increased rates considerably since March of 2022. So I think they've moved up 525 basis points over 11 different rate hikes from early 22 and to present day. Looking at 2024, 2025, you can see that both Federal Open Market Committee members and also markets, financial markets, are expecting that the Federal Reserve will eventually start to reduce the federal funds rate. So the expectations coming from the Federal Open Market Committee, the median expectation, are shown kind of in the diamonds there. So you can see that the median participant serving on the FOMC is expecting about a reduction of about 75 basis points in 2024. Of course, that's not built in, that's data dependent. And then they're expecting another 75 basis points of cuts in 2025. So this is by the end of the year. So those are shown in the diamonds. What's shown in the solid lines is financial market expectations. So you can see as recently as January 1st, so in that kind of burgundy bar or line there, markets were really expecting cuts to be pretty significant. So they were expecting a faster pace of cuts than the Federal Reserve was communicating. And you can see that between January 1st and much more recently, as of last week, we see that green line. And so you now see that markets are expecting essentially the same thing that the Federal Reserve is expecting. So that we've probably reached our peak level of the federal funds rate. but the cuts are going to be a little bit slower to materialize. And really the reason for that is that the committee doesn't expect that it's going to be appropriate to reduce that target range for the federal funds rate until it has gained greater confidence that inflation is moving sustainably towards 2%. So we showed that we'd made a lot of progress towards 2%. We're not quite there yet. And we have some of these factors that are just kind of hanging out and keeping inflation a little bit elevated. So we're just looking for additional data that helps give us some more confidence that that rate is moving down to 2% sustainably. And so I'm kind of tying this into the question that was asked there. Frequently market lending rates are closely aligned with the federal funds rate. And so you can see that here the expectation is that likely rates will come down fairly gradually over the next couple of years, but that the pace will be fairly gradual and that we're not looking necessarily for an immediate cut, right? You see that it's probably we need a little bit more data to start that trend. And so I would expect that to kind of move into other areas as well. On the commercial side of things, not my expertise, but we do see, particularly on the office space side of things, with vacancy rates moving up, we know that there were a lot of kind of lease renewals that were shorter than normal, kind of during the pandemic and then the year after the pandemic, as a lot of businesses were looking needed some time to figure out kind of where the economy was going to land, what their office use was going to look like. So we know that there will be more kind of space up for renewal than normal over the next couple of years. So a lot of leases will need to be renegotiated. And so probably will create some pressure on especially that office space side of things where vacancy rates are considerably higher than they were pre-pandemic. So I think there's probably the most pressure on that side of things. If you look at the other sides of commercial, industrial, like warehouse space, have fairly low vacancy rates. Right now, multifamily remaining fairly low vacancy rates. So the other sides look a little bit healthier, but the office side has seen an increase overall. Were there other questions?
Nope, I think we're good to move on.
Okay, well, so that
hang on.
really concludes. So so overall, I mean, I think it's a fairly optimistic outlook for the U.S. economy. Most economists are expecting that GDP growth, the overall economy, will grow at a little bit slower pace in 2024 relative to 2023, but at a pace that's still above kind of what we would consider to be a trend rate of growth. So a pace of growth that would be consistent with a fairly low unemployment rate. So we might see a little bit of a tick up in the unemployment rate, but again, not expecting the unemployment rate to move up sharply, expecting wage growth to continue to moderate, but still remain fairly healthy. And then looking for that inflation number to come down further. So we think that the additional progress will be probably a little bit slower than what we saw over the last couple of years, but will continue to, the committee is committed to achieving that 2% inflation target. So we'll do everything that it can to make sure that inflation rate gets back to 2%. So when you look at the forecasts coming out from the Federal Open Market Committee, expecting inflation, just looking at the central tendency right now, for headline inflation, expecting by the end of the year, the median is about 2.4% and about 2.2% by the end of 2025. So additional progress there on the inflation front as well. So I'd say a pretty optimistic picture for the U.S. economy. But happy to take additional questions. Also wanted to point out here some resources from the Kansas City Fed's Economic Research Department. A couple of QR codes that you can look at to get e-alerts from any of our publications. A couple of things shown here that you might find of interest. Charting the Economy is a relatively new publication of ours that's just basically a chart and a very short text, so very easily consumable. We have that on our social media, but also on our website. Labor market conditions indicators combines 24 different labor market indicators to kind of try to get a picture of the overall labor market. So that might be something that you find interesting and want to follow. Comes out monthly. And then we also have a financial stress index to see how the overall stress levels in the financial market, and what that might mean. So a couple of different resources there, but other publications available too through that email alerts. But happy to take other questions if there are any.
Terrific. Now is the time for our attendees to type in that Q&A field or in the chat field. I'm going to ask our committee members to come back on, Ryan and Ken and Carl and such. And there is a question from Ken that we'll start with. Do you see the upcoming election affecting the economy?
Ooh, that's a tough one. So the Federal Reserve definitely tries to stay out of politics. So, I mean, I guess I'll just say, so I'm going to kind of avoid the question. But I guess I'll just say that overall that, the Federal Reserve is an independent organization apart from politics. And so our mandates were set by Congress. The mandate is that dual mandate that I mentioned earlier to achieve maximum employment and price stability. And so those are, will stay our focus regardless of who's elected this year.
Can you talk just briefly about the tendency for election years to impact the economy in a growth fashion?
Yeah, again, probably not my expertise. I mean, I think overall, I mean, I certainly in elections years, it generates a lot of the media attention is on that. But I think when you look at the overall economy, you see a pretty healthy economy. I mean, so I don't think, although it generates a lot of attention in an election year, and for good reason, it's certainly an important election. But I think the economy is in a really good position and shouldn't have a huge impact.
Mm-hmm. Okay. Matt, Carl, Ryan, Ken, any additional comments or questions?
She got all the stuff on my list.
Same here.
Good. Yep, I have nothing.
Good. That's great. That means you answered all of their questions. I think that your presentation was fabulous. I like what you're saying. I hope that the continued stability offers our industry and others what we're looking for in terms of labor markets and manufacturing growth and so forth. So we appreciate your research, your time, and your effort. There may be additional questions that we reach out to you for following the program.
Well, great. Well, I appreciate the opportunity to join you today, and appreciate everybody joining in. I know it's always hard to find an extra hour in your day, so appreciate people attending, and hopefully the information was useful. And yeah, if you do have any follow-up questions, please let me know.
Excellent. I do want to encourage the group that's on the call to recognize that our next webinar is scheduled for May 22nd at 11:30. That is specifically related to our financial benchmarking survey, which is actually coming out next week. I encourage you to participate. It is important. Without your participation, we don't have the data to analyze, and that survey is only going to be open for 3 weeks, a total from April 1st to April 19th. It is a fairly easy survey to fill out, less than a half an hour of your time with fairly easy questions, not nearly as extensive as some of the others that we've done in the past. So we ask for your participation so that we have good data to report back. Ken, Carl, Ryan, you guys have probably filled it out before. Any comments there on ease of use?
My experience last year was it was pretty easy to use. You don't have a lot of numbers. It's a lot of opinions and yes, no answers. So it should be pretty straightforward to complete. So I highly recommend that everybody that is given that or sent that through your various organization to please complete it, because the more people, the merrier. It gets us better data.
For sure, agreed.
I would agree as well.
Matt, you'll be a part of the presenters on May 22nd to analyze the data that comes out of that survey and talk about what we do with it, what it means. Any comments there?
No, I would just echo kind of what everybody is saying as far as the more input into the survey, the better the data the output is, and the more useful it will be. And it'll provide for a more robust conversation for the webinar.
Excellent. All right, I do not see any other questions coming in. Any comments from the committee before we end the program?
Have a great day.
Excellent. Allison, thank you again for
Thanks,
your
Allison.
presentation. The
thank
information
you.
was terrific. Thank you to the committee for coordinating it and preparing the questions and so forth. If you have any additional comments or questions, certainly reach out to PIM or to Mid-America, and we will help get that information to a committee member or to Allison to answer those questions. Have a great afternoon, and thank you for attending.